Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsarthi. And so there's a huge amount of activity that's happening in financial markets, both in India and globally. A lot of issues that have cropped up over the last 2 months, especially the war in the Middle East, which is like taking all the sound waves, sound bites and airwaves. And that is also driving markets up and down. Too much of noise coming from there. Ceasefire, no ceasefire, straits closing, no closing, a lot of noise. That's also driving up and down commodity prices, driving up and down currencies globally. A lot of geopolitical tensions, and in all this, you have the whole specter of AI in terms of disruptions in businesses, economies, etc. So all this put together have led to volatility across markets, and this has not spared any market actually. If you look at the equities, they have been really volatile, going up and down on a zigzag pattern. If you look at the government bond yields globally and in India too, the yields have shot up on the fears of inflation. Currencies have depreciated. The rupee touched record lows of 95, close to rupees 95 to the US dollar recently, and then it stabilized around that, but still a lot of uncertainty on the dollar rupee front as well. You have the foreign institutional investors selling equities and bonds. They're selling bonds largely to book profits on the forward currencies hedge they have created, where forward rates have gone up, have doubled over the last few months from 2.5% to 5%. It's stabilized at around close to 3.5% plus as of now. But again, there's still a lot of uncertainty there as well. The central bank in its policy in the first week and the first and second week of April, they came out and said that they're holding rates, staying neutral on policies, but remain vigilant across on the impact of financial markets. In all this, liquidity has been pretty good, close to four trillion or rupees 4 lakh crores of surplus of liquidity, which is keeping a few things stable. In all this state SDL in the recent government bond auctions, yields have shot up and then come down. SDL yields, state development loan yields have gone up, and spreads have gone up as well. You have yields of AAA bonds going up. You have even the commodities, which is gold and silver, have seen sharp, violent swings up and down, even though they have performed over the last 1 year, the commodity index, but the gold and silver at least. And in all this, what is the market thinking of in terms of where is the calm, right? And you would be really surprised to hear the calm is actually in the high yield space, high yield corporate bond segment. And I'll tell you why it's been calm and why it may still be calm going forward. But before that, just do subscribe to our podcast channels. We are available on YouTube. We are available on Spotify, Apple Podcast, and Amazon Prime. And also, please do like the podcast across the channels. And also, if just to mention the risk in investing in bonds, bonds carry interest rate risk. Prices can go up and down. Credit risk, that can be default, and liquidity risk, where the impact cost of buying and selling can be high. All this put together, your investor should understand the risks in investing corporate bonds and should either do their own due diligence or consult with their financial advisor for investing. Now, back to the topic. High yield bonds remain calm amid chaos in financial markets, both in India and globally. And this is very surprising. Normally, when there is a lot of volatility across markets, the first segment to get hit are credit spreads. And credit spreads get hit, that is high yield corporate bond market. and these get hit because of the fact of the many factors that affect them. One is the issue. If there is an economic weakness that is going forward, then there could be deterioration in balance sheets of high yield bond issuers, and that could lead to increase in risk premium and higher yields and higher credit spreads as well. And the second is also that normally there's a flight to safety, and flight to safety is normally in government bonds, which is your G-Secs in India and US Treasuries in the US and across other sovereign bonds, right? And this leads to a sharp fall in government bond yields globally. Um, and the third is obviously because of the fact that there's a lot of finance market volatility, the liquidity dries up for high yield corporate bonds. And when liquidity dries up, sellers cannot find buyers, and buyers quote higher prices. So bid-ask spreads rise. And this leads to a sharp rise in credit spreads of high yield bonds. But in this market chaos, what we have seen is a completely different phenomenon, right? In India, at least, what we've seen is that government bond yields have gone up. And the reason for government bond yields going up, we have covered in our March podcast, March 26th podcast, where we said that the demand is looking to be uncertain, and there's a huge amount of supply that is coming forward from government borrowing, both central government and state governments. And with RBI forecasting higher inflation in the recent policy, they did say that inflation expectations, the risk is on the upside, and their expectations are it will be above that target range of 4% floor, but up to 6% they're fine. 4 to 6% is their range. For a long time in financial year 25-26, it was below 4%. So that had given them a leeway to reduce rates, but now you don't see any kind of rate cuts. The second is that if the economy faces some issues because of global issues, global tensions, and a lot of economic downturn globally, exports fall and other things affect the economy, then you have the government that will come to support the economy through higher borrowing, through pump priming of the fiscal deficit. All this is put together has led to rise in corporate government bond yields. And because of government bond yields rising, the rate sensitive where credit factors are not really prevalent, which is AAA PSUs and AAA corporate bonds, they have also been rising because of the fact that government bond yields are rising, just in sympathy with the government bond yields, nothing to do with the credit concern. But and the rupee too, while depreciated to its record lows against the US dollar, that leads to liquidity concerns. But having said that, liquidity has been very, very vibrant in the system, and the RBI has been pumping in huge amounts of liquidity through purchase of government bonds in the market, through open market operations, and also through secondary market purchases, and also through for FX swaps. And so they have infused. So RBI could have infused close to over rupees 5 lakh crores in the market over the last 3-4 months. All this put together has kept liquidity positive. And what this liquidity is definitely, and rates have not gone up substantially as well, because if you look at fixed deposit rates of banks, they have not really gone up. And banks are not really too worried about their liquidity situation, because they have enough liquidity and they don't need to raise fixed FD rates to get more liquidity to lend. All put together, the FD rates are down. So generally, the short-term rates, if you look at it, while 10-year government bond yields have moved up to close to 7%, and the 30-year has gone to 750 and 760. You also had at one point of time in very fearful times, you had the 5-year swap, which is a 5-year OIS, going close to 7%. But all these have come off. The short end of the yield curve has come off, and 5-year OIS is at close to 6.4% now. 5-year G-Sec is also close to about 6.5%, 6.65%. So around these levels, there's not too much anxiety in the market. though the curve is steep in terms of the repo rate is at 5.25%, but even the short-term rates, for example, even the one-year swap rate, which is it's at 5.88%, which does indicate that there could, if because of inflation, there could be some kind of rate hikes or liquidity tightness going forward. But all put together, you don't have, there is still a visibility of liquidity, and also that the rates are going to stay low. And all this is actually playing into the high yield bond market in India. And high yield bonds, by when I mean high yield bonds in India, I mean what anything less than AA, rated less than AA and below, going all the way to triple B plus. There are a few factors in this, why this market has been extremely stable. One is that on the credit quality front itself, we did see this high yield issuers going through some tough phase, especially the lenders in the last 2 years. Right, there has been a down cycle in credit, and like microfinance went through a very stressful times. You had MSMEs and SMEs also going through some stressful times. You had a bit of wobble in the other segments, including commercial vehicles segment, etc. But what the lenders have definitely done in the last 2 years is have strengthened their balance sheets. Also, they've gone extremely risk averse in terms of they have tightened their credit underwriting policies as well. So standards and all put together, they have come out. They say they don't want to grow too fast, but they would rather grow in a steady pace with strong fundamentals where the bad loans are not acting up, and they don't want to go down their underwriting standards. So in all this, the market perception of high yield issuers, especially the lenders, which is the NBFC segment, has improved. And here also, couple of more things have happened. Is that there has been a lot of confidence by foreign money into the Indian sector. So we had the largest ever financial segment deal where Abu Dhabi IHC has pumped in 5,600 crores into rupee 5,600 crores into Samman Capital, taking over promoter control, and they are looking to pump in another about 4,000 crores to conversion of warrants by the end of this year, and that conversion of warrants is backed by Abu Dhabi Bank guarantee, and also they have floated an open offer to the market. It's a listed bond to take their promoter control to over 60%. All this put together, this is a huge confidence boost for the Indian economy in terms of, at least in the lending space. And also we have seen others where Fullerton took promoter control over lending card. You had Warburg Pincers taking control over Fusion Microfinance, Baines investing in Ashirwad Microfinance. All put together, then you have a lot of Japanese banks pumping in money. Shriram Finance got a AAA rating on the back of Japanese bank investment, taking 20% stake. All put together have lent a lot of confidence to lenders in the Indian economy. And coupled with underwriting standards, low interest rates in the economy, even though government bond yields have been volatile, and the fact that there have been a lot of stability in the balance sheets of these. And we have not seen too many downgrades, a few downgrades here and there, but they have seen more upgrades actually in the last in the last year. And the fact that many of these lenders have gone through a tough credit cycle and have stabilized their growth and credit, and also have tightened underwriting standards, all put together have led to a calm in the high yield bond market in India. So that's why the high yield bonds are still very, very stable. And here the yields are ranging anywhere from 9% going all the way to 13-14%. And obviously there are risks at lower rated bonds. So investors do have to do their strong due diligence or check with their financial advisors before investing in high yield bonds. But the fact that in a sea of volatility, there has been an island of calm in high yield bond space in India. that's where we are. And thanks for listening in, and do follow us on all podcast channels.